Hey, good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, October 16th, and we do got some important economic news releases to cover today. We'll jump on in the inflationary numbers, the Consumer Price Index, or otherwise the CPI for the month of September. So back in August, we had a 0.6% increase, which is obviously a pretty high number. We figured it would taper back slightly to 0.5%, and basically we had the same number for September. So 2 months in a row we had 0.6% increase, which shows obviously this is the headline news. So this is including food and energy prices built into it. So this is what's creating the volatility. But once we strip that out, we got the core CPI because of volatility of the food and energy, we take that out, and that's really what the Fed will look at for inflationary numbers. And we had a 0.1% back in August, and we figured it would go up slightly to 0.2% and remained again 0.1% for the month of September. So pretty tame numbers, even though the headline's kind of a bit scary. But when you take out the food and energy, the volatility of those two areas, it's actually pretty tame. Next one is industrial production for the month of September. We had a negative number back in August, and we figured it would kind of improve a little bit to about 0.2%, and we went past a little bit. So pretty good news there. Industrial production for the month of September showed some improvement. And last but not least, we got the home builders index. This is the index that will kind of gauge what the home builders are feeling, where things are moving, for if they're going to forecast. If they're getting excited, they're obviously going to be building more. If they're not so excited, they're not going to be building. So we had back in September we had a 40 on the gauge. We figured it jumped up to 42, so some more improvement. Didn't improve, but not quite much. There's just a little smidgen of improvement there, so not great news right there. So right now we'll jump over to the headline news and see what we got in store for us. The stock market's up quite a bit today. Dow's up over 100 so far this morning. A lot of that has to do with some good earnings reports that are sent out so far today. And then also they're kind of like this possibility they've been kind of pushing Spain to take the bailout funds from the European Central Committee after they came up with that program. So right now they're kind of mulling over that line of credit. If they do take it, there's a lot of strings attached to that. So that's why they're not real keen on taking it, having to agree with some very strict terms. But it may be what they need to do to make sure that the markets are happy. Because if the markets aren't happy, they probably won't be able to sell any of their bonds on the open market. So this might help calm the markets a little bit by them taking that line of credit from the European Central Bank. So let's jump over to see how the interest rates are doing by looking at the bond market. So as a result of all the money leaving the bond market, we had a big drop here. So we got opening gap here. These usually don't last too long. These usually will close up a little bit within a matter of days. So right now we're at 104.84. We dropped down about 25 basis points. Well, actually a little bit more. Yeah, about 25 basis points down from where we left off yesterday. So hopefully this trend doesn't continue going downward trend. As we've seen, we've come down here, we came up a little bit, and we're coming down again. So this could be a trend where we could come down, where maybe they're cashing in, maybe kind of correcting on the pricing a little bit. So we may have seen our highest up here, the 106 level. But right now, pricing obviously is still good, but definitely you want to try to keep an eye on if you're floating your interest rates at all. But right now, rates have climbed up a little bit today with the drop here in the pricing on the bond market. So interest rates are a little bit higher today. All right, folks, thanks for stopping by. You guys have a wonderful day. I will see you guys tomorrow.